This is how stupid this market is. You're increasing companies' valuations at a commensurate level to the debt they are taking on, which is by definition a liability, which is not accretive or not additive to a market cap valuation.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And as always, I am joined by the brain trust himself, Mr. Chase Taylor. And as always, it seems like we're always knee deep in a really interesting conversation when the recording starts.
Dark one. So let's move on from it.
Oh, really? You want to move on from it? You don't
Yes.
want to? Okay, fine. Now I can see. Now it's.
I feel like the average show is dark enough.
See, now I got the listeners all ginned up here, and you're rug pulling them. But that's what you like to do because you hate fun.
Well, we can stay dark on finance. That's not a problem.
No, yeah, that's getting easier by the day. Before we get into all that stuff though, little rundown on the markets here.
Yep. So not much going on, but S&P up 0.17, Q's up 0.48, but really kind of more of the same. You had Mag 7 up 1%, but equal weight down 0.24, small caps down 0.32. So more levitation from the top only thing kind of going on. All world ex-US beat the S&P. It was up 0.33, which is kind of notable because the dollar was up again 0.16. So to get that outperformance from overseas on a dollar up day, never nothing. Oil basically flat. Nat gas had a good day, up about 3%. Gold up about 0.5%. Silver down a tiny bit. Yields up yet again with the 2-year and 10-year, both up about 3 basis points. As far as where the gains inside Mag 7 came from, mostly Amazon with some Nvidia and Tesla sprinkled in essentially. Vol down 1% on the day.
Palantir announced earnings.
Yeah, didn't even look.
Well, I just checked after hours. It was basically flat. It spiked at first.
Saw they beefed up their guidance on revenue, but that was also.
But it elicits, now granted, Palantir is an extreme example in every single way. But for those of you out there, like I saw the Palantir cheerleaders posting their Qs and like all celebrating, well, this is why they're an amazing company. And I'm looking and I'm going, that's all priced in, bud. They better execute like that for another decade just for you to be able to rationalize the price you currently own the stock at. And the funny thing, I think the reason I bring it up is I think it's a really good educational tool. Now, this thing could accelerate and go. I think it's going to be stuck here in South here for a while. We'll see if I'm right, but you've got one of the largest now corporations in the world trading at about 120 times sales.
That's
okay.
Crazy.
So my thing is then here's the issue. And to me, this illustrates the problem of large numbers that we've been talking about better than anything else. So they have a blowout quarter, quote unquote blowout quarter, right? Government revenues in their government segment was up like 52%. Like it looked like the whole company's growing 40, 45%, somewhere around there, right? Great quarter. Beat expectations. Which everybody's like, oh, they beat expectations. I'm like, okay, sorry. I forgot you're new to this game. So guys, that they always beat expectations because they put out expectations they know they can beat. Okay. So whatever. But it's just the math side of it, right? So you're left this amazing quarter, and now you're looking at them at a revenue run rate. They up their guidance forecast, right? They're forecasting a revenue run rate between $4.5 to $5 billion a year. You're already at a $500 billion market cap.
Yeah. No, thank you.
I just like I've said it before. Like I don't. If you own that stock at this price, you're not an investor. Period. Full story. Like full stop. I'll just say it right now. That is. You go to Kalshi. Go bet the ponies. I'm not saying you can't win, but I mean, it's just not. That's not an investment. I mean,
that's a dream catcher. That's it.
It's something. I mean, what do you? I mean, you're buying something at 120 times its revenue because it's growing so fast. Boy, it better be.
Never mind the fact that there's a lot of things growing faster than that are not valued anywhere near that.
If they 10x their revenue from here, they're still trading at 13 times revenue. If they 10x their revenue, they're trading at 13 times revenue at the stock price,
which is in itself pretty crazy.
Yeah. I know we've talked about it a million times. Well, it just still amazes me whenever you see a stock fully separate from any kind of tether, where it's just doing its own thing, where you're like, hey, why not, man? Make it $1 trillion, make it $2 trillion.
Speaking of the crazy,
pretty remarkable.
Speaking of the crazy numbers, we talked about the other day how much of the MSCI All World Index the U.S. took up versus China.
Yeah,
the Mag 7.
I talked about that on my show on Friday alone.
So just NVIDIA is now worth more than the following countries: Japan, UK, China, France, Germany. Like, if you take all of China's contribution to the All World Index and Germany's, China and Germany, NVIDIA is basically the same as those two countries' contribution to the All World Index. So we just passed Japan like basically in the last week. Japan was like the last country that it had to take out, as it's bigger than all the countries. Just bananas. And then, like, just to be clear for listeners though, like, that doesn't mean that's the market cap of all those countries. It means that's how much of the All World Index they are. But that's still insane, because that index is tied to a lot of mutual funds and ETFs and investments. So like, it's not nothing just because it doesn't represent the whole market cap.
Well, no, and I'll just tell you, I mean, how many funds out there are indexed against the MSCI World Index? Tons. And when you look at NVIDIA's position, if you're going up against that portfolio, you have to own NVIDIA. Or not when it goes down. But I mean, either way, I mean, that's I mean, and people can see the minute something is in an index at that representation, it also simultaneously has to be in all these other portfolios too.
Yep. So you get to the point where the top has a drawdown. It's almost impossible for like the whole to go up. We're there with Qs and S&P, where if those top 3 or 4 have a drawdown, like, it almost doesn't matter what else happens.
No,
it's just like a wild albatross.
Yeah, the weight's too much. And the crazy thing too is again, law of large numbers, meaning, we're also used to the grind higher. If you get a gentle grind higher now at these levels, 1% and 2% days are the equivalent of, 75, 100% of these firms' annual revenues. It's just getting to the point where, as crazy as it is now, I think you're very close to being at a place where, like I said, and I'll still stick to it, if we do keep taking off from here and keep grinding higher, I do believe that'll be the beginning of the end. I don't think you can take off from here and not fall on your face.
Yeah. I mean, and especially if all this AI stuff we've been talking about, if that doesn't play out the way the optimists suggest and the market is betting on, then, we're the only country going all in on this stuff. So if it doesn't work out, then we're the only country that has a lot to give back on it.
I'll flip it around and look at it from a little bit different perspective. And I spent a lot of time thinking about it this week. Let's spend some time thinking about it from a different angle. Let's spend some time throwing some actual math out there and putting some figures out there and kind of trying to pencil out what kind of things you need to see occur over the next 5 years to not make that. And I played around with that a little bit in my head this weekend. I couldn't get there. Like, in terms of you have a dollar problem effectively, right? Which is, the investment is so large in this, even if the return is even if the returns are commensurate in some way, shape, or form, how can they be? Meaning, when you look at the type of investment going on here, in order to get a return to justify that investment, you don't need pickups in productivity. You need economic booms. You need GDP. You know, like, for instance, you can't pull enough GDP from enough other areas without collapsing them.
Right.
To feed that economic activity toward AI.
And what makes that awkward is if it really is going to cost jobs, jobs equal income, income equals spending. So how does this get escape velocity while it destroys the purchasing power of the people that are supposed to buy it?
Well, everybody goes, well, UBI. And you're like, guys, okay, not only are you extracting super intelligence and complete home runs on all this investment, now you're saying you can handicap one of the most like controversial and rightly so pieces of legislation. You're just saying, I mean, you look at all the stuff that they're just saying is going to work out there. And it's just,
it's not only is it going to go from a horrific ROI to a very positive one, it's going to be so positive that you're just so flush with cash, you can just hand it out to the plebes to satiate them because they lost their job. Like, there's so much wrong with all of that. Like, and there's so much built into that. Like, talk about unintended consequences and unforeseen risks and political problems and geopolitical problems and social problems that are all baked into those assumptions.
And yeah, you see it everywhere you look. You see those assumptions everywhere. You see it in the Palantirs of the world. You see it in the Teslas of the world, right? Tesla shareholders holding on to this thing at $1.5 trillion because Musk says Optimus is going to be 80% of their revenue.
But don't worry, the flying cars are coming too. He just said that.
Yep, flying cars are coming.
And I will say that may actually be one of the few areas where I'm like, I could see them actually doing well in that and making some money. Now, I think they could do better with that than a lot of the other stuff they're promised. But
my whole point, look, I've said this before. I'll never bet against Musk again because the guy's been able to pull stuff off. That my whole point is, you just see this trend of it is amazing to me what this market will just buy without even inspecting, right? Just buy wholesale, which is, we'll just run Tesla up to $1.5 trillion because Musk says Optimus. We're going to run Palantir up to 500 billion because it's the greatest thing ever. We're going to run, we're going to build all this. I've talked about what idiocy it is. Like, and I know I sound like an old man when I say this because other people are going to be like, well, there's so much.
We should rename the podcast Yelling at Clouds.
Yeah,
we do that around
here.
Here.
Get off my yard. Get off my grass. But the narrative has just gotten so stretched on so much of this stuff.
And it's all narrative.
And it's all narrative. It's all narrative. And everybody, you've got this weird thing where everybody is just suspended disbelief. It's just like, it's going to be so amazing. And even while it doesn't play out, like, look at where so many of like the crypto and Bitcoin maximalists said that crypto and Bitcoin would be by the year 2025.
Right.
It's not even close. It hasn't changed at all.
Not even them, but like investment banks went there too.
Yeah.
Just like they did with oil. Whenever oil bros on Twitter were talking about $300-400 oil, next thing I knew, here comes along JP Morgan talking about $250 oil or whatever. And it's like, oh, okay.
But at least then you could see a mechanism and a path there. I mean,
maybe to 200, this 300 plus stuff. Like,
yeah, well, no, because like
understanding supply and demand.
Well, right. Cause like you said, and nobody, like a lot of people aren't gonna be able to afford it.
And the amount of production that you would have all of a sudden at that price.
Oh, it'd be coming out of
I would have drilled a well in my backyard.
Yeah. It would have come out everywhere. But yeah, that to me is, it's that we're awarding trophies for a race that isn't even 1/10 of the way done. And it's not me saying they're wrong. It's not me saying they're right. It's me sitting there going, I have no idea what you guys are all betting on. You know what I mean? Like, yeah. I just, well, why? That's just because you haven't placed a bet. I'd love to. I don't know what you're betting on. You're like, well, I'm betting this happened. I'm like, well, you're paying a price that reflects the fact it already did. Which in that case, what are you betting on then? You know what I mean? Like, you're betting, you're hoping that you don't lose your money. That's not an investment. Like, it's just not. And if you think these multiples are going to hold and people are still going to keep paying 20 to 30, if you think that this market is re-rated now 20, 30 times revenue is a sustainable valuation, I mean, it kind of has been for a while, but I'd bet you dollars and cents we're closer to that being over. I mean, just think about that, man. I mean, you go back to Palantir, $4.5 billion of revenue, and it's $500 billion. I like structurally, I don't know how you look at that and say it's a buy or like, I don't know. What do you call that? I mean, I wouldn't tell you to short it.
Right. I mean, yeah, that's obviously a bad idea.
I mean, I will say,
you get real lucky with the timing. Or you get real lucky with the timing, or you just buy long dated puts and assume it goes to zero.
If I was in that business, I'd probably buy a very small stake in some long dated puts right now. It just feels jump the shark. And that's the one thing that has kept me from hammering on the blow off top. Here we come, even though it really feels like that. It feels like that and it looks like that to me, but there's a very jump the shark feeling right now that I just cannot escape. And I totally it started with Meta last week.
Exactly. And Oracle to a degree has been punished a bit.
Palantir popping right off of their earnings announcements and then selling off and going red. Even though they went back to even, but still it just,
by the way, we are entering like peak awesome for seasonality. This would be interesting because if you go back to when seasonality was supposed to be a headwind, this year just wasn't. And I think it's a lot of that's because everyone was looking at it.
Yep.
And guilty, right?
Yep.
I own it. Now we're entering like where seasonality is supposed to take off.
And now everybody's bullish again.
And for the technical nerds out there, last week was a shooting star candle, which not perfect, but oftentimes will actually mark a bit of a trend change. So change the subject real quick, but I think a lot of people are probably familiar with the Milgram experiment in the 1960s. This is when they basically tested out if someone would obey an authority figure, even if it turned into shocking someone.
The Stanford trials, right?
Inflicting pain. I think that one's different. So it turns out people will actually shock other people that, because they're told. This feels like a different kind of experiment where it's like you give the buzzer to all these like AI CEOs and they're like, all right, here's the thing. Every time you hit the buzzer, you're going to hurt someone, but they're going to give you $100 million. And they're like, okay. And they're like, they hit the buzzer and it's like, ooh, yep, here comes some capital. Like people want more of that. Because the way I see it, like the more CapEx they do, unless they actually hit the super intelligence, right? The more that is hurting not just their shareholders, but just the market in general, like maybe society, the country. Because if they get this wrong, they've just burned trillions of dollars. But because it equals them getting money right now, because it has, the more CapEx you do, like the more money you get, and everyone loves it, and your share price goes up. So like people just keep hitting the buzzer, like, well, I'm going to keep shocking these investors until they stop giving me money. That's why like that last week, just I can't get out of my head that finally maybe people got tired of getting shocked. Like I don't know.
No, I agree with you. I can't get past that. I can't get past that feeling too. But it also has to do with, so oftentimes, in this business, you're operating on part of the information most of the time,
always,
right?
Yeah,
you're never
very imperfect.
Yeah, you're not operating with any information, and so not all of the information. So what I'm always looking for are little tells, right? The market will give you tells, and for lack of a better term, that's just the tell I've been getting lately. Meaning,
and to be clear, Meta and Oracle down today on a Mag 7 up 1% day. Those two, they're kind of most tied into this. Like, let's see how much money we can borrow and spend on AI. Like those two down again.
When I see stocks, again, as always could be wrong, but when I see a market that is rewarding investment as if it's profit. And here's the other thing to remember. This is a little crazier than most people think. It's almost like double entry accounting or something like that. Today, Google was up 1%. It was funny. We were talking about this, right? 1%. That equals $30 billion. Okay. That is virtually the exact same amount that they said they were going to take out in debt today. When you take out a debt offering, your stock is not supposed to go up that same amount. Okay. More importantly, when you look at it on an enterprise valuation, that $30 billion debt that they took on has made their market cap effectively go up $60 billion. Well, enterprise value.
Right.
right? So think about that. This is how stupid this market is. You're increasing companies' valuations at a commensurate level to the debt they are taking on, which is by definition a liability, which is not accretive or not additive to a market cap valuation. That to me is a tell.
Yeah.
And that to me will also go down as one of the hallmarks of this cycle that people will talk about for years. Remember when it was so nuts, people were treating CapEx like it was profit.
Yeah. And I think part of the reason for this is everything these tech giants have done, it was profit. Like if they were putting money into something, like you could basically just assume, oh, that equals profits. This means it's going to go up. And that was right for 15 years. But again, going back to like,
because they were leveraging their infrastructure.
In nerds putting stuff on the internet, not people having to build real stuff that costs hundreds of billions of dollars.
Well, and it was also, they'd all built these unbelievable ecosystems that were just cash farms. So when they put this
is the opposite.
Yeah. When they put a new gadget or new gizmo in there, or a new feature or whatever, you knew, and internally they knew by the data that they had on their own consumer bases, they could literally within, fractions of a decimal point sit there and go like, yeah, well, we're launching this new initiative in our ecosystem, and that's going to jump revenues by another 9.8%. And they're usually right on the money because they built this captive audience, right? This thing. This could not be more different. If anything, for most of them, let's say that these big tech investors are winner in the AI race. AI is going to endanger their original business model, right? Their core business. Almost all of them are going to be threatened in some capacity, their main core business by AI in itself. And I agree with you. Everybody's treating like this the next social media or something, like, because all of these investments have worked. This is just totally different. It's totally different.
I think a lot of people that invest in tech, especially like the tech, like real tech experts and stuff that have been in this space, investing in this space for 20 years or whatever, other than the .com bubble to a degree, like they just don't know what it looks like to have a giant CapEx cycle potentially go wrong, because they've never seen that. I think a lot of people that have done commodities and industrials and stuff, that heavily cyclical things, because tech's not that cyclical. You don't have to worry about down cycles. You don't have to worry about, missing a debt payment or something, because why would you have to worry about that? But, if you've dealt in like offshore oil vessels or, oil rigs or, whatever the case may be, like you know what this can potentially look like. So I think that's why you see a lot of people that aren't necessarily tech people that are looking at this going like, hold on a second. Like, do you know how this can end potentially? Like, do you know what this could do to you? Not even. And they're like, what do you mean? No, like you're investing and you'll get a great IRR on that eventually. And then what do you mean? It's all going to be fine.
Yeah. Well,
maybe not.
Yeah. When you're investing the same amount as like viable countries' GDPs, like that's the part of this that it's like the flip side of the coin that nobody's paying attention to, which is you're saying it's going to be huge based on your investment. It better be.
And this doesn't scale like everything else they've ever done.
It's nothing.
Everything else was like an upfront cost, and then the more people that used it, the more money you make. On this though, like every time I go make an AI image, that GPU has to spin up and cost them money.
Yep.
Like they don't get to scale me. They get to spend money on me.
Well, the other part of it that's going to be tough, and especially in the early, like this stuff, a lot of this stuff will work itself out over time, right?
Sure.
But one of the things that's going to be real tough is you get going down this path and you got a really good thing and you're, making something of it and you're investing and you're getting it rolling. And all of a sudden a new AI comes out that completely obsoletes you overnight. What do you do now?
Yeah. And one of the things I was talking about this morning is like, at some point, whenever this becomes more about the products and services that flow from how good AI is, what that becomes about largely is going to be the cost, right? Like, if you just happen to run one little app that does one little thing, say it's, you're the chatbot at the drive-through at the restaurant, like your business is to sell those to restaurants. Like, of course you can't have the thing be stupid, right? It has to know what it's doing to a degree. But at the end of the day, if I'm that business, I just want to plug myself into the cheapest model so I can make the most money. The cheapest model that's effective.
Yep.
Like I don't need Grok 9 I just need the one that doesn't mess up and is cheap.
Well, I'm not going to have any loyalty to it either.
Right. So yeah, exactly. So my fear is like you reach this point where the commoditization of it just goes to the cheapest denominator of effectiveness. And that A isn't going to be in America. So you have to wall it off because everyone will just take the Chinese model because power is 2.3 times more expensive in America as is in China. So by definition, the input cost is radically lower there. And they're being smarter with the efficiencies and stuff already. So then you're just going to go to the US model that's the cheapest because I'm assuming we're going to say you can't use that one. So if you put all this money into it and then you have to make it the cheapest one to get everyone to tap into yours, the margin, even if you can become profitable on this, is going to be thin. Because if not, like if you try to extract some decent rent out of it, people are going to be like, no, thank you. I'm going to plug into this model because they're cheaper today.
It's really weird to say this, and I've got to come up with the terminology and I've got to think it through. But as incredible as the tech is, there appears at this point, at least from my perspective, to be a commodity-like aspect to it that is very different from other technology that we're used to. You know, like all the technologies that you've seen developed and all the big tech companies that you've seen, you know, blow up and become so profitable. There was this built-in monopolistic aspect of their company that it truly was a flywheel. Like it was self-propelling. This is just not. It's not at all. And
I don't think we can get there.
Yes.
So someone can harness it better than everyone else and productize it better than everyone else and stuff. But
but
is that going to be OpenAI? Probably not.
Well, here's the tough part to me. If I can try to let me give you a stupid guy's version of my issue with it. It's really odd that you're developing this super technology, this super intelligence, but that is also your product. Meaning, the better you make it, the more power you are handing in the hands of your consumer base, which they can use that same compute power to not need you anymore. In a lot of applications,
they recognize that. I think everyone's viewing it as a total winner take all. Someone's going to build magic, and everyone will have to line up and kneel to it and pay them.
That's the one thing that's not going to happen.
Tends to not work out that way. Most things don't.
No, especially
this could, I guess, but
not when you look at the history of the internet. That is to believe that one group is going to get out in front and stay out in front. That just never happens. And in the past, what you were able to do is just through size and scope. You know, once you got a lead, you could just double down. You buy up competitors, buy up competition, all that other kind of stuff. I just think in this world, it's coming at you too fast.
Especially these valuations, no one's going to buy each other because no one's going to be able to afford that.
No, yeah, right. No one is going to be able to afford it.
So speaking of, I've been talking about the signposts of CapEx going from rewarded to punished. We may have hit that threshold last week. I think the next big signpost is going to be when someone has trouble raising money. So whenever one of these companies tries to sell a bond, tries to raise more venture funding or whatever, and people aren't picking up the phone or they want to change the terms or whatever, like so far, Silicon Valley is just writing blank checks and Masayoshi-san's writing blank checks and like no one cares. So you can get a 40-year Oracle bond less than 2% above treasuries, right? Like no one's having problems selling this stuff.
Kate, that is to me, again, one of the biggest bubble signs I see out there.
It's wild to me. Yeah.
What in the hell would you want to buy? What?
All that duration risk and the risk of that company.
And why?
And all that revenue depends on AI getting more venture money so that they can pay you.
And this is the thing though, for those guys, if I'm a CEO of one of those companies and they're throwing debt deals at me like that, I'll probably just take them and pocket the money.
And I think that's part of it. Like the shock thing, like, oh, you'll give that to me. Okay. Well, let me shock you again until you say no.
Yeah. I just think about the investment. What in the hell would you want Oracle or Meta bonds for? I like what?
40 year. If you buy the 5-year bond, we're like, well, sure, whatever.
Well, but also like put me in the part of the capital stack that basically means I can't win, but I'm exposed to all of the risk. How do I get in there?
Not to mention like macro risk, like surrounding inflation and stuff too, Like,
well, and currency risk, inflation, all of that stuff. You're locking in at 5. I mean, if it's 8.5, you and I were talking about it's 8.5, 9.
And the Meta 40 years were like trading above par very recently. I saw that. I know as of yesterday or Friday, the Oracle one had gone to 95 cents. So I'm watching that thing like hot because if that thing gets to, 70, 80 cents on the dollar or something, that's telling you the market's starting to really change its mind about this stuff.
You know what, man? I'll say this. Put a gun to my head. I'd prefer to have a 20 to 30% levered up treasury portfolio.
I know, like that. So that's exactly what I said. I was like, the last thing I want is treasuries, and I'd rather have a treasury than that.
I'd rather have a leveraged treasury portfolio than that.
Yeah.
No, at least you've got the chance for some capital appreciation, because you and I both know when this cycle does end and this market starts moving down, those bonds are going to sell off just like the equity.
Given the sums and the, again, if you're Oracle, the only way this thing works out very well is as long as people keep funding OpenAI. And I know the market views OpenAI being able to raise all the money they've ever wanted to for perpetuity is like, oh yeah, of course they'll be able to, but why? Like, and to go back, a lot of people I know we're talking about this weekend, but the interview with Sam Altman where you got asked the question, you're supposed to do 13 billion in revenue this year, and you have 1.4 trillion in spending.
And this is a friendly
This is the guy
interview.
that's invested in him, loves him, like And he asked him that question. And he got super offended by it. Was very defensive.
So
how is that not a very obviously good, decent question to ask?
Well, and that's another thing that I'll point to where I'm like,
but it's not just them counting on it. It's Oracle counting on it. It's the NVIDIA counting on it. It's GDP counting on it.
And it's the jump the shark thing. Like Altman's, I'm sitting there listening to Altman's response to that, and I'm just like,
if you give that guy another dollar after that, I don't know what to tell you.
Well, yeah, I'm just listening to the response of that, just going. The only thing I can really equate it to.
How can you ask that question in an all shucks manner, not a terrified manner?
Did you hear the way he answered the question from Tucker Carlson about the guy that got murdered?
No idea.
Well, the guy that supposedly killed himself, even though they found blood in 2 rooms and he'd ordered DoorDash like 5 minutes before he supposedly killed himself. And the wires to his security cameras have been cut, but it was a suicide, right? Guy that worked at OpenAI and was a whistleblower. Maybe Altman is perfectly fine and is a good actor. I just know that he gives like some of the most shocking answers where you go, dude, if you're not guilty, why are you trying to sound like it?
Yeah, his answer to that question was.
I'm just telling you, if I was invested in OpenAI right now, based off hearing that interview, I would try to see if I could sell my positions or get out. I would not put another.
Yeah, and so in his answer, he got all fired up and was like, "Well, if you want to get rid of your shares, but I'll find someone that wants them."
Yeah, and the guy was like, "I want more."
And the guy, he's like, "Oh, he backed down."
Yeah,
more.
yeah.
Like, I'm sorry. If
somebody,
if I was an investor in him and he was like, "I'll get rid of shares," I'm like, you know what? Let's do it. Let's set it up. After we record our podcast here, let's sit down and let's set that up.
Yeah, if that's how you're talking to me,
yeah, let's lock that in right now.
Yeah, it's a,
because if you can't answer that question, it's pretty basic.
Well, yeah, it's not only that either, and I don't look. Sometimes experience in this business can be the worst thing for you.
100%.
Right. But what I will tell you from the old book, like the old toolbox, that sounds eerily like the lady doth protest too much.
And no one even really protests. It was like, that's what's bothersome
just
about it.
Just a simple, like you're not prepared to answer the ROI question, considering the investments that you guys are putting in.
And they're supposed to do 13 billion in revenue all year. Just for the third quarter, they lost 11.5 billion. So they're lighting all of this money on fire with no verbalized way of ever getting a return on it. I'm not saying they never can, but I am saying they haven't explained it.
Well, no, but that's what I'm saying. It's almost like the market is treating this like somebody's building another social platform or something like that.
Right.
It's like saying because
the last guys figured out how to make money on something that seemed crazy at first. So of course this will work.
Yeah. So we know this is going to work. It's going to be so great. And you're like, hey, so guys, this is really
Let's talk
different.
about social media CapEx
versus
this.
Well, yeah, because and the metrics are completely different. For instance, I haven't heard anybody with a serious plan, and I don't think they can based on the spend. They're not going to be able just to sell Grok ads to finance this spend. Like Google ads and Facebook ads and all that kind of stuff, right? The other thing is the beautiful thing about those social media platforms is they cost consumers nothing. The consumer was the product.
Right.
This is not like that at all. Now you're asking people to pay upfront charges.
Right. Or they're gonna have to pay the VIG when they shop on there or whatever. Like because I do think they can make nice revenue from stuff like let me help you get your airline fee set up or whatever. Like the agentic stuff and the buying for you and just taking a little fee. Like they'll make money.
Yeah, but even think about that. Like
then someone's gonna outcompete you because they're not gonna charge the fee or whatever.
Yeah, and then somebody else will develop another agent bot, AI based bot, and undercut your price by half. Yeah, and as long as you have one of if I'm an airline company. I can see the value in that. I want an AI client representative as quick as I can have one. And every single year, I'm going to go back to vendors and see if I can get one cheaper that can do the same thing.
Yeah.
Right? Because think about it. It's not like hiring another person. You could be changing new AIs every single year for less and less price. And the end user may never know. No.
Right.
You'll outfit it the same. You'll make it look exactly the same.
Yeah. The average product, you don't know what they're plugged into and you don't care as long as it works.
No.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
What else anything interesting today other than the thing I'm looking at the most right now is just the overall market because like I said, you look at the indexes, it looks like a breakout. Having said that, you've got historically, this would be the weakest conditions internally for a market to break out. You've got breadth that is just atrocious.
Yeah.
And we've seen bad breadth through this cycle. This is taking it to a whole new level.
Speaking of, Brent Donnelly shared a really good, I can't remember what the metric was for the specific bad breadth, however bad the advanced decline line or whatever, the ratio of winners and losers was. But he showed this on a long-term chart and it was a line here, a line there. And then you get into the last 2 years and it's just line. Where this bad breadth thing, I always ignore it because I'm whatever. It never seems to move the market. But to see that chart, I'm oh, wait a second. This feels like a bigger deal than I've been giving it credit for. Seeing how clustered it is in the last couple of years.
Yeah. I think it's one of those indicators, like so many market indicators, that it's all about context. Meaning, there's certain times I think it's important. There's a lot of other times for idiosyncratic reasons you can perfectly understand why that's happening. For instance, another good example of this. I remember breadth was horrific when the shale deal imploded in 15 and 16, right? Understandably so. And I wasn't freaked out about the breadth then because you understood why those other stocks weren't selling off. You understood why those ones were. And you understood that if those stocks were selling off, it didn't portend well for the vast majority of the rest of the economy. So you'd expect bad breadth in that scenario. Yeah. Whereas then I look over at Google and, maybe it means they grow at 8.5% instead of 9.25% this year. You know what I mean? It wasn't that big a deal. But in a situation like this, I personally think it's a lot more telling.
Yeah.
Right? Meaning the breadth isn't bad because something bad is going on. The breadth is bad because the only people willing to continue buying at these prices are price agnostic buyers. That's why the breadth is bad. Let's be honest, right? There's a lot of people buying because they're just looking at going, or not buying because they're I just can't buy that. And when you look at markets trading at these levels, at this price area, all that kind of stuff, bad breadth means something different.
And to be clear, why I think breadth matters at the moment is because if you look into the earnings kind of forward-looking earnings expectations for equal weight in a lot of the bottom, whatever you call it, 80% of the market, that actually isn't very good. So it's not just the price is sluggish, the fundamentals are a little sluggish. And that's concerning. And then maybe more importantly, if you look into the cyclical stuff, it all of a sudden has turned down. So we had liquidity go straight down, market didn't really care. Now all of a sudden you have, the dollar up, rates up, to a small degree, oil's picked up. So those put pressure on the rest of financial assets and markets and the economy for obvious reasons. But now all of a sudden you have the cyclicals versus defensives kind of coming down a little bit. Consumer cyclical equities are down over the last month or two while AI stuff goes straight up. Our buddy Warren Pies had a great chart on that. Just straight up for AI, all of a sudden down for consumer cyclicals. And it's it has a real economy feel to it, at least for the moment, that it's well, that bears watching. And, if you think about this in the backdrop of the government shutdown, is the government shutdown ultimately going to end up being a big deal? No. Have they ever been a big deal for the macro economy? No. But we're pressing into, close to like 40 days. Real people are missing real paychecks, real programs that are missing real funding. That starts to mess with the economy. Like, if you know intuitively that high deficits are great for the economy, you know that when you kind of freeze the deficit this way, it's bad for the economy. And there are some, there's some small, very high frequency indicators that are starting to show like, you should probably, if you don't fund the government soon, like you start running into some issues.
Well, and some potentially other issues, right? Like one of the other things that is concerning is that, you and I have talked about so many times, you can't take any one indicator or any one reading and take it too far and extrapolate it out. That being said, when we see a lot of the stuff you're talking about, and again, it reminds me of another conversation you and I were saying. We're not talking in the extremes here, meaning everything is so, the market's about to collapse. Oh, the market's about ready to go up, limit up, I think it's much more nuanced, right? And generally speaking, markets usually are more nuanced. But I just can't get away from that jump the shark feeling and the bad breath readings. And then, like I was saying, when you see things like that are concerning, then you see additional things that are going to be straining on consumers, like student loans being payable now. Okay. Right. And even before that kicks in and you start seeing the impact of that, you're looking around and pretty much everywhere that's consumer facing is saying the same thing.
Right. Restaurants are.
The consumer's clearly slowing down. Yeah. Now, the question is this an air pocket? Yeah. And do they recover or do they go up? I don't know the answer to that.
Yeah, nobody does.
Nobody does. My suspicion looking at the overall economy is that the consumer's running out of gas. Now, I don't mean that, plummet time, but just in terms of this upward, if we're a rocket ship, it feels like the engine's kind of going, you know what I mean? Just kind of sputtering out.
Yeah. Time to spray the carburetor with some starter fluid here.
Yeah. It certainly does feel like that. Again, I'm not, no big, huge concerns and sitting there saying this is about to blow up or that's going to blow up. But
I think there's a good debate on, is it early cycle, mid cycle, late cycle? And I think all sides of that argument have some ammo. But I will say the last week or two, I think the late cycle people their cause is picking up new ammo to a degree.
The argument I can't get behind is early cycle. I just don't see anything that would suggest early cycle.
I don't know. I mean, you look at credit spreads, you look at, even now retail sales is still humming along pretty decent. We're cutting rates. That's going to add some stimulus to some people. Like, I think you can make the argument. Now, I think mid-cycle makes obviously more sense than early, but, and we've had a lot of these little mid-cycle like slowdowns where it's like, oh, we have a problem. The next thing you know, you're fine. Third quarter GDP is going to be 4%. That doesn't scream problem by any stretch. So I don't know. And even the market, the market's telling you everything's great, obviously, other than the breadth, but in the equal weight S&P lagging hard on Mag 7. But that's the concern to me, is like, I don't think anyone can argue this point. And that is that AI has been like a hot air balloon attached to both the economy and the market. So, and I don't think the AI like investment thesis is like burning now. I think it's just finally showing some fraying rope here. But if you lose that balloon, like that's tough for the economy and for the market. And that's why I think it takes on more importance than I would like it to, because I don't want to watch this closely every day. I don't want to care about Oracle bonds at all. But knowing the lift that's given the real economy and the equity market, it's like, okay, well, I have to look at Oracle bonds, because if there's a problem there, then there's a problem for everything. Yeah.
You're approaching this moment that I didn't ever think you'd actually get there, where you have to always entertain the idea that you could be wrong, right?
It's irresponsible not to.
Yeah, 100%. At the same time, if we are wrong, it means that, disqualifying statements like, Oh, so you're making the argument that that single company is going to be the entire size of the U.S. economy? If we are wrong this time, yes, I guess for us to be wrong, that would have to be possible. I mean, we're approaching those levels. I mean, that's
right.
And that's why I'm sitting there going, hey guys, trees don't grow to the sky. Okay. And that has become your new investment thesis.
Don't tell that to AI trees, Zach.
Well, yeah, I know. But it's the old, with an attitude like that, of course not, you got to,
right. I mean,
you got to at least believe
there are some basic physics involved in the gravity of this thing that are, if they're not being completely thrown asunder, like they're being doubted. That's my beef I understand pricing in some right tail on this stuff and giving it some proper due. I just don't understand ignoring the left tail of it, especially when it's so unclear how this investment makes money in the future.
Or if you're I understand how
Which is why the Oracle meta price action matters a lot.
Yeah. And I understand if I would understand and wouldn't think it was as incredulous if the investment community's attitude was, you know what, we're not going to beat your stock up for this investment, but we're also not going to run it up either. We're going to wait and see what happens. But that's not what they're doing.
And I even understand if someone was like, I bought some crazy calls and some crazy puts on Meta. That makes sense because they're either probably going to crash and burn on this not working, or they're going to take over the world and your calls will be great.
Yeah.
I don't understand only buying the calls. That's basically the argument for the whole thing.
I don't understand how you could think that the calls are the better bet.
I mean, me either. And full disclosure, I only own the puts. But
yeah, well, and I don't own any of them, and I'm not advocating anybody go out there. But I'm saying if you put a gun to my head and I've got to either buy one or the other over the next year, I'm buying the puts. And I'm not buying the puts because I necessarily believe those stocks are going to get hammered.
No, it's just, but if they do, you need it.
Yeah, you need it. And also,
because we all get hurt.
Yeah. And also, if you look at it through a lens of history, you'd be an idiot to take the calls.
Yeah. And if this AI trade goes pear-shaped, and then maybe 3 years from now, but along the next decade, if this thing was like, ooh, this isn't working out that good, and it gets punished by the market, like, You may own some stuff over here that has nothing to do with AI that gets hit. Like, you may think you have no exposure to this, but you do. And that's real economy. You may work in HVAC and business is good now, and you may not realize how much of that's because AI has tightened up your market or whatever. So,
or maybe maybe no part of the underlying economics has changed. People just start selling the S&P. That's the other part of it too.
Yeah, plus, all it takes is for a few European pension funds to do it. And we're all in trouble.
Like you've talked about for a long time, man. I mean, this beautiful reflexive cycle of stocks go up, stocks, all up and to the right all the time. There is a backside to that mountain, and the inverse is the exact same to the downside. And when people start selling it, that whole beautiful escalator you've been on for the last 15 years, it starts moving the other direction.
Yeah.
And when you look at where the valuation of this stuff is, it can move a long way. Like, I mean, bust out a Netflix and a Costco. How long can the S&P 500 go down before those things are screaming buys? 50%. And even then, they're not screaming buys at that level.
They're just buys.
Yeah, they don't look expensive.
Yeah.
Right? So I'm not saying that's going to happen.
Like the amount some of the emerging markets have to go up before you feel like is
you're looking at 150 to 200% runs on a lot of these things.
You got a long ways to go.
Yeah.
There's some Chinese companies that, I wouldn't let go unless, they triple. And that's when I start feeding back, forget selling it all.
Yep. All right, man. Well, that about does it for me. You got anything else you want to add?
Ran pretty long, so that's good.
All right. Well, as always, you guys, we will see you tomorrow. Thank you so much for listening, and check us out on social media. We're both on Twitter at KYR Radio's Mine. Chase is at Pinecone Macro. Also, you can get the video feed on YouTube just search Know Your Risk Podcast. Just Google Know Your Risk Podcast or go knowyourriskpodcast.com, subscribe and download. Anyway, you guys know the drill. Have a fantastic evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.